Good morning, everybody. It's Monday, August 17th, and it's 11:01. I'm a little bit late here, but we'll catch up quickly here. There's lots to talk about, of course, as there always seems to be in our business. The great thing about our business is there's never a dull moment, but that's also one of the downsides of our business. There's never a dull moment, but I see from the turnout that many of you are not on vacation, at least today. But I do also see that there's some that must be on the beach who haven't joined us today. So it'll be a smaller group today. Maybe I can get to more questions along the way, and I look forward to a little Q&A at the end of our usual half-hour session here, which drags on for a few minutes. Anyways, weather is kind of rainy here. Not a great day, but we can always use the rain and a little bit of moderation in the temperature. Summer's approaching the end. The New York Tennis Open is around the corner. My wife likes to go there. I sometimes accompany her, but sitting on those hard benches doesn't do it for me. Or the hard chairs, if you trade up to the arenas, which I guess yeah, that's where all the action is. But lots of action in tennis and lots of action in the markets. Here we are, basically at an all-time record high in the S&P 500. We've also seen that this has been a good year for broadening. For the past few years, everybody's been kind of waiting for this market to broaden out. Everybody was focusing on the concentration risk that this bull market was not sustainable because of the concentration risk. But I don't see too many people talking about that anymore. The Magnificent Seven have actually underperformed this year, and the impressive 493 have done impressively. They've done very well. These small cap stocks, the Russell 2000 keeps going on to all-time record highs. That's rather important because also over the past few years we've been waiting for the small cap and mid cap stocks to participate in this bull market, which started back in October of 2022, and yet we had kind of at least a couple of years where we were hoping things would get better on that score, but that wasn't the case. So the concerns were that yeah, the market was going up, but just a handful of stocks were doing it. Well, we don't have that concern anymore, and the small cap and mid cap stocks are doing extremely well this year, and we've seen the market broaden out in sectors. Financials and industrials have done well, and so has healthcare. All in all, the bull market carries on, and it's carrying on because of earnings. Let's talk about this being 1999 to 2000 all over again. But there's still concerns about whether the irrational exuberance this time is in earnings. I don't think so. I think there may be some exuberance in the earnings situation, but we tend to follow the analysts when we think that the economy is going to continue to grow. The analysts do a very good job of anticipating what earnings are going to do over the next 12 months, with one rather important exception. They do not see recessions coming. And that's our job, and your job, my job, is to kind of assess that. The analysts talk to the companies. The companies aren't very good at give them a heads up that things are falling apart. So typically, the analysts are lowering their earnings at the same time that all of us know that there's a recession going on. So having an opinion on the recession is rather important, as we all know in this business. That's good for what I do for a living. Since the beginning of this decade, we've experienced the most widely anticipated recession of all times that just wasn't happening, the so-called Godot recession. We were on the right side of that argument, and I think by now the market investors have caught on to the resilience of the economy. So it's going to be a little harder to convince the consensus that a recession is imminent. And we can look at poly markets to see what the bets are on a recession this year, and it's I think around 10%. Interestingly, though, we don't have poly markets. We got Kalshi as a question for next year whether there'll be a recession, and that's actually up around 40%. I guess there's still the further out you ask people about a recession, the more likely they think it'll be, which kind of makes sense. I mean, that's it's logical, but the market right now is basically discounting what people currently think about the outlook for recession anytime soon, and that's gone down a lot. And again, I think that speaks to the fact that the economy has been remarkably resilient, and that it's withstood a lot of shocks, the pandemic, the lockdowns, the supply chain disruptions, inflation, the Fed raising interest rates, mini financial crisis in 2023, the tariffs, the war, the oil price, two oil price surges. And yet here we are with the economy at an all-time record high. There was a bear market along the way, as we all know, back in 2022. There was a bear market, but it was a very unusual bear market. You usually don't have bear markets that aren't associated with recessions. And again, that bear market that definitely demonstrates just how panic-prone people were about the possibility that there would be a recession. And in 2022, we had the Fed raising interest rates because inflation was surging. We had Russia invading Ukraine, so oil prices surged. So a lot happened that was kind of put it together, and there was a logic, obviously, to the idea that there might be a recession, but it didn't happen. In June of 2022, a bit early, we called the bottom, and that didn't work out too well. And then we called the bottom in October. What happened in October is we kind of retested the June low. We made a new low, but not significant at that point. And we started to see that the bull-bear ratio was extremely low. Everybody was bearish. And once again, we looked at the weekly earnings that the analysts were putting together. We saw some moderation, but we certainly didn't see that they were really cutting back their estimates. So we kind of combined with our view that there wasn't a recession and them kind of hanging firm on earnings, we concluded that October of 2022 might have been the low, which it was. And then, fortunately for us, I guess, in that story, it wasn't too long after that. It was November 2023 that ChatGPT came along, and that clearly boosted capital spending. But along the way, consumer spending was also very strong, and I think that was one of our contributions to economic science, the observation that the baby boomers had a lot of dough, and they were likely to retire and spend that dough, and their net worth was becoming more important to consumption than disposable income, especially since disposable income was likely to be weighed down by the fact that all these baby boomers that were, making the most money they'd made in their careers were retiring. Obviously, they wouldn't have done that if they didn't feel that their net worth was enough to carry them forward. So here we are with basically the same story on the consumer. Here we are with a stronger story on capital spending. Oh, yes, and then there's that pesky federal deficit. It's $1.5 to $2 trillion. Right now it's stimulative, but we're all watching the bond yield, the 10 years up to 4.7%. Again, our view is we don't get too jittery between 4 to 5%. Obviously, I get a little more jittery as we get closer to 5%. But this could be a repeat of 2023. 2023, we saw the bond yield go from 4 to 5% in a matter of 3 months. Between August, September, October, November 1st, we got to 5%, and there was loads of buyers. The Treasury announced that they needed more money. but they would raise it in the bill market. And Scott Bessent at the time in the private sector thought that was a really dumb thing to do. Now he's probably going to do the very same thing, and that is if he needs more money, he's going to be raising it in the bill market. Um, and that might calm the bond market down. We also think that we're all kind of waiting to see what Kevin Warsh does or does not do. Right now, it's a bit of a toss-up. I mean, the retail sales numbers were weak, the employment numbers were weak, but then my view of numbers that don't support my story. They're they're not good. They're bad data. They're going to be revised, or I can spin a story to tell you why they don't make much sense. So we did that. Elias and I did that with the employment data. We pointed out that a lot of the weakness was kind of funky, leisure and hospitality, that it might have been related to the end of the World Cup. And then we pointed out that, as others have, that s- uh, state education employment, state and local education employment was down big, and that could certainly be a seasonal issue. And then with regards to retail sales, there too, we had non-store retail sales take a big drop in July, but that's after they surged in June. So that might very well have had something to do with Amazon's Prime Day. And there was something else. The auto sales were weak, which really didn't make a heck of a lot of sense when you looked at the unit sales that the Bureau of Economic Analysis puts out. But all in all, we think the economy is still doing just fine. The initial claims data point in that direction. The JOLTS data points in that direction. There's plenty of jobs out there. One job for one unemployed person. And then we saw the NFIB, the National Federation of Independent Business. They came out with their latest survey of small businesses, and the employment indicators there were pretty good in August, I guess it is. We'll see it in a minute. So let's have a look at some charts. The bottom line of all this is we think earnings will continue to carry the market higher. Everybody gets jittery around September times. We're going to have a September FOMC meeting, and maybe that will give us some pullback in the market on jitters about what the FOMC is going to do. But right now, I think after the weaker than expected batch of economic indicators, with cooler than expected top line inflation numbers, that the Fed will hold off. So we may have a meeting with the same three dissenters that we had back in the July meeting. But we've been pointing out, others have been pointing out that yeah, the inflation cooled off some in the recent numbers, but we're still not at 2%. But then Kevin Warsh may be crossing his fingers and hoping that we're kind of heading in that direction. Then again, the geopolitics isn't being very cooperative. We now have the Strait of Trump. I don't know if he's going to call it the Strait of Trump or the Strait of America, but that's basically a dodgy area to say the least. Then again, Bloomberg had a piece saying that one way or the other, oil is seeping through that part of the world and getting through to the rest of us. And that certainly seems to explain why the price of oil has been fairly calm here, somewhere between 80 and $90 a barrel. A lot of nervousness that we're running out of strategic petroleum reserves. Others, reserves are running dry around the world. And maybe bang, suddenly all of a sudden we'll get a big spike in the oil price. I can't say that won't happen. But then again, oil is a liquid, and one way or the other, it seems to be getting through the Strait, and there's other sources of oil. And then China's really cut back on their spending on oil imports, and that might very well have something to do with the fact something we've been pointing out. And that is China's. It's not a basket case, but it's not doing too well. Actually, I've previously described China as the world's largest nursing home operated by Maoists, and still feel that way. Their economy is not in good shape. Z is it's kind of weirdly confident. I think he thinks we're going to that the U.S. is falling apart, and that China is going to be the ascendant power. But their economy is not performing very well. He thinks that China can continue to export their way into growth, and that's obviously going to create even more trade tensions between China and the United States and Europe and other countries. And he doesn't seem to be too fazed by the fact that real retail sales, year-over-year percent change, are basically zero. Here's a country with, bazillions of people or millions of people, over a billion, and the growth rate of real retail sales is zero. And meanwhile, production has slowed, but it's still north of that. So they're still producing more than they're consuming, and they're dumping it into the rest of the world, creating deflationary pressures. It's not a good long-term model for sustaining economic growth in China. Let's turn to some charts here. Okay. I think I'm getting better at this. I don't screw up as much. I shouldn't have said that until I got it done. Here we go. There we go. Okay. Now I can say that I'm not screwing it up as much as I have in the past, but you never know with me. Okay. The topic is of our talk today is hawks versus owls at the Fed. That's pretty clever, right? Instead of calling it hawks versus doves, there's owls. Owls are just kind of like sitting there thinking about things, looking around for what they should do next. Hawks are more proactive, and they're always flying around looking for the action. And we know that there's at least three hawks at the Fed, the dissenters who would have liked to raise interest rates at the July meeting. And then, despite the data that's come out since, they still seem to be hawkish. So they still have a view that inflation hasn't come down to 2%, and they're not necessarily on course to get there. By the way, I didn't read the article, but I saw a title, something to the effect of the latest craziness from Russia. That's where the craziness really is to block off grain exports from Ukraine. We're back to that story again, which was concerned back in 2022, and that may be sending grain prices higher again. So maybe oil prices are going to stabilize here, but now maybe we have to start worrying about food prices. But here in the U.S., I don't think we really have to worry that much about the labor market. I mean, the unemployment rate is at full employment. 4.1% is full employment. And whatever it's not a weak demand situation. It's really a weak supply situation. I mean, using the word weak is kind of subjective. Objectively speaking, there's a slowdown in the labor force related to the retiring baby boomers, stricter immigration, and a significant skills mismatch between what companies need and what the current people who are currently unemployed can actually do. So we're not particularly fazed by the so-called weakness in these payroll employment numbers. We think they're basically running around, I don't know, 0 to 50,000, and maybe that's all we really need. The ADP data shows the same thing, that back here we said that a lot of this weakness in January was weather related, and we expected to see a bounce back here, and there was, and the bounce back was because the weather got better in the spring, and then of course we had the preparations for hiring people for World Cup, and then it's been frittering away ever since. But again, I think that just kind of reflects the new normal in the labor market. Meanwhile, on the demand side, this is the NFIB Small Business Survey, job openings, and yeah, it's July, not August. July, we saw big increases in the no qualified applicants for job openings, so that's the skills mismatch. We saw with one or more companies with small businesses with one or more job openings, that jumped up. It's a volatile series, so I don't want to make too much of it. But of course, when data supports their story, it's very good data. planning to increase employment. That was a big solid increase. So I'd rather have that than the other way, of course. Um, the participation rate, woe was me. People are dropping out of the labor force. Yeah, but they're retiring. Um, or they're on a plane back home if they're being deported or self-deporting. And then there could be unemployed people who just are dropping out because they don't have the skills that are necessary. But again, it's the story here is not that things are so bad that people are dropping out of the labor force because they're so bad. The participation rate of 55 years and older, that's coming down. The 65 years and over, notice that was actually going up here. A lot of the baby boomers kind of kept working into their 60s, and now as they get into their 70s, what's the expression? The gray old mare, she ain't what she used to be. That or they're feeling pretty good and they figure, hey, our net worth is pretty good. We can give up our income and let's see the world while we can, while we still have our health. So the participation rate is coming down. The foreign labor, the growth rate of the foreign labor has come down. So again, nothing. I mean, it is what it is. This is not like terrible stuff. And it would be terrible stuff if it meant that, hey, look, if the labor force growth isn't growing, how can the economy grow? And the secret, of course, that's no secret, is productivity. And that's what we're counting on. That's part of the roaring 2020 scenario. By the way, foreign workers have a higher participation rate in the labor force. Let's see, percent. Yeah, I think that's what this is. Foreign born as a percent of working age population. They have a higher one than native born. I think we had that chart here. Uh, yeah, right here. So this is the foreign participation rate in the labor force. That's coming down. I guess if you took a moving average, it would look like it's coming down. This is the total participation rate, which obviously is going to be affected more by native born. And native born has been kind of heading lower. Um, the job openings looks fairly flat according to the Indeed data. Um, Here's the job openings based on JOLTS, and you can see this is retailers. They got more job openings, and that's usually an indication that retail sales are okay. Um, the manufacturing is the purple here. That's come up. So retail, and then manufacturing, construction at least has bottomed out. It's pretty volatile. Federal government, even the federal government needs some people, believe it or not. Um, let's move on a little faster here since we're taking up a little bit of time from the Q&A. What else did I want to point out? Yeah, just wages, utilities. That's been pretty strong. Uh, Yeah, inflation. Yeah, it's inflation's come down. That's CPI. By the way, the CPI for some funky reason has actually been a lower inflation rate than the consumption deflator, and usually it's the other way around. And usually the consumption deflator is 0.5 percentage points lower on average than the CPI. But now we got it exactly the other way around. And a lot of the discrepancy is in durable goods. So durable goods inflation looks more moderate in the CPI than in the deflator. The deflator is still what counts, and there's more inflation in the deflator than there is in the CPI. This is headline versus core PPI, and you can see the total is 4.7, and the core is 4.2. I mean, those are not exactly comforting numbers. Uh, what other numbers? We threw a lot of numbers at you here, so just to kind of make our case, I think we'll move on now. Yeah. Okay, let's move on to this one. Roaring decades. Yeah, we just made the point that we've made before that we kind of stuck our necks out by saying the 2020s remind us of uh, potentially remind us of the roaring 1920s. And we actually wrote that up in August of 2020 a time when it looked particularly delusional. But it's worked out so far so good. And I guess what we were trying to point out in this chart is that roaring decades are not that unusual. At least from the point of view of the stock market, the 1950s was a roaring decade, as was the 1920s. Then another roaring decade was the 1980s. Then we have the 1990s. This was a pretty good decade back here. And if we get to 10,000 on the S&P 500 by the end of the year, by the end of the decade, or the end of the year, we'll see how things go, then that'll be a little bit better than what we had in the, I think it's like 209% would be the increase. So the bottom line is the market tends to go up, and occasionally you get lost decades. The 30s certainly was a lost decade. These were nothing to get excited about, obviously. Very, very pathetic returns of the market, another lost decade. So will this be another lost decade up ahead here? I don't know. Let's do it 1 year at a time. Actually, I am meeting with a reporter for lunch. We both live in the North Shore of Long Island, and he wants to talk about if the 1920s are roaring, will the 1930s be roaring? And I'll make it up along the way. But I'm optimistic, as I typically am about the roaring 2030s. But then again, if we're talking rhyming here, I sure hope the 2030s don't rhyme with the 1930s. Talk about a geopolitical disaster. That's what the 1930s were. And the 2030s could pan out to be a geopolitical disaster as well. Things are pretty crazy right now on the geopolitical front, obviously. Anyways, looks like we're going to get a nice double-digit increase again this year. So that would be the fourth year in a row of over 15%. What's the chances we'll do that for a fifth year? Not that great, but we did that in the late 90s, and that was kind of, there's a certain deja vu all over again. Let's party like it's 1999. Maybe we should party like it's 2029. Just charts confirming what we talked about before. The market cap S&P 500 and the equal weight all record highs. The outperformance of the 493 compared to the Magnificent Seven. That's healthy stuff. Russell 2000 all-time record high. Healthy stuff. Oh, we always have fun doing this with you folks on Mondays. Look at this. This is the analyst expectations for 2027. They just keep raising it. And this does not include mark-to-market projections of mark-to-market gains. I mean, the 2026 got a big boost from gains gains that Alphabet and Amazon had in SpaceX and other areas. It's conceivable that if Anthropic goes public, there'll be even more huge gains here, but analysts don't project those kind of gains. So this is a pretty clean number of what analysts are really thinking, and this is forward earnings. Will approach that. So right now we're at 410 on next year's expectations. We think by the end of the year, it'll be a 415. Put in a 20.24 multiple on that, and you get 8,400. Profit margin, forward profit margin, all-time record high. Earnings breadth, really good up here. Maybe worry words will start to say, well, if next thing it does, it goes here. But it could do something like that. It could do something like that. But for the here and now, the earnings breadth is awfully good. Same goes for the forward earnings of small cap, mid cap, large cap, all looking great, and so on and so forth. Let's go to the Q&A. Okay, Anonymous, happy Monday, Ed. Thank you. Kevin, will the long bond yield go back down in the coming year, or is it headed higher for longer? I own some, and I'm wondering, should I sell before yields go higher or hold and wait for the price to recover? Well, answering your question can only get me into trouble. Um, but here's our macro thought on it, as opposed to individual advice. 4 to 5% is kind of back to normal, and we think we're back to normal with the 10-year running between 4 and 5%. The bearish factors are what everybody knows. The Fed has gone from a dovish to a tightening mode. Now, I'm not quite sure what mode they're in, but last we heard they were thinking about raising rates. They might wait, but that kind of hangs over the market as a possibility. The inflation story has not been resolved to the market satisfaction. Inflation isn't at 2%. The federal deficit is huge and getting bigger. In the past, supply and demand weren't that important in the bond market. It was inflation, expected inflation, and what the Fed is going to do about it. But this time around, at some point, we may get to a point where the market cares about it. My long-held view has been kind of developed over the years is that I'll worry about the deficit when the bond vigilantes worry about it. So I did get worried in 2023 when we went to 5%, and then much to my relief and everybody's relief, the bond yield hit 5%, and there were plenty of buyers. I think the same thing will probably hold here. But we do have a lot of supply. We got the government supply, and then we got the hyperscaler supply, and maybe that's finally gonna matter. So I'm not going to dismiss that possibility. But for now, our base case is 4 to 5% is the range, and at 5%, if we get to 5% again, you'll see plenty of buyers. But oh, by the way, the other thing I should have mentioned is this has become a global bond market, and the global bond market's concerned about the fact that the Japanese central bank is going to have to raise interest rates if they want to stabilize, keep the yen from falling further. And as I think what got everybody jittery is that Scott Bessent had to come up with this clever way of helping the Japanese to support their currency by buying yen with euros. I'm sure the ECB wasn't particularly happy about that. Ian, your take on the Japanese dollar and Japanese bond market is impacting the Fed's decision making, given the repo facility invoked for Japan. Your take on whether a Fed rate hike would impact oil prices if all other than demand destruction, and what rate would that? That's a couple of moving questions here. We just kind of briefly discussed the yen and the Japanese dollar exchange rate. And I think it's widely anticipated that the Bank of Japan will raise rates. Maybe the big surprise is that they do 50 instead of 25. Maybe instead of baby steps, they take a leap and say, we just got to stabilize our currency. Otherwise, they get more inflation, and then they get beat up by the U.S. for having a cheap currency and dumping it in the global markets. With regards to oil prices, I don't know that a Fed rate hike would make much difference to oil prices. Commodity prices, generally speaking, are being driven up by the AI trade, particularly copper. Recently made an all-time record high. Oil prices, I think that's like most commodities, it's supply and demand. Well, lots to keep us busy this week, and I will see you again next week. Thanks all. Have a good week.